Thank you very much. As Tony mentioned, my name is Jeff Hanson, and I am here today and tomorrow doing two things. One, giving some educational seminars. Today, generally about loan repayment. Tomorrow, about repayment options for those of you who are interested in working in public service, either with a government agency or a nonprofit organization. So if you have an interest in public service, you may want to also consider coming to that seminar tomorrow, or at least watching the video, because I will not really have time today to talk about the Public Service Loan Forgiveness Program, which is a very good benefit if you're planning a career in public service, because you can get a portion of your debt forgiven in a 10-year span of time. What I want to do today is to help you understand the importance of developing a strategy for repayment. Before you graduate, the university is going to ask you to complete a process called exit counseling. It's mandatory. It's something that the government requires the school to have you do, where you are given information, as you did when you first borrowed the loans in entrance counseling, about the terms and conditions of the loan. But what they don't talk about is strategy. And the reality is, federal student loans are the most flexible form of credit you're ever going to have. There are choices that you're going to have to make when you enter repayment. And the problem is, how do you decide which repayment plan and which repayment options are going to best meet your individual needs? And that is not typically something that is discussed in exit counseling. That's what I want to focus on during the next hour or so, because it is very important that you make well-informed choices about how you take charge of loan repayment, because it's a process that's going to happen one way or the other. You can either take charge of it yourself, or you can let it take charge of you. If you let it take charge, it'll be probably more complicated. It could end up causing you to get into some trouble financially. It could cause you to not be as successful in achieving other financial goals as quickly as you might have. So it's very important that you're ready for the process when it begins, and then you've thought about a plan for repayment. And that's really what I want to do during the next 50 minutes or so. Now, the slides that I'm going to be showing you are going to be posted to the law school's website. There is another handout that's also going to be posted, which is what I call the loan repayment worksheet. And I'd encourage you to look at both of those, but particularly the loan repayment worksheet, because it really is a four-step plan that can help you develop your own loan repayment strategy and loan repayment plan. And I think it provides a lot of useful information that is not what you're going to be getting in exit counseling. Also, I am here meeting with individual students in 30-minute appointments in the admissions office today and tomorrow. If you're interested in meeting with me to have us look at your own individual situation and have me help you develop that plan, you can check with Alice Foley. I believe there's still a couple of appointments available, and it's an option you have, and I'd certainly encourage you to consider taking advantage of it. So as we go through the slides, if you have questions, don't hesitate to stop me, because my whole purpose in being here is to educate you on how the programs work, but more importantly, how to think strategically about repayment, so that when it comes time to making decisions, you are well informed, so that you're making the decisions that will best meet your needs. I think it's important for law students today, actually for all students, to realize that if they're having to borrow money to get their education, they're really graduating with an educational mortgage. It's the financing they've needed to make this investment in themselves. Now, it's an important investment because it's what's allowed you to be here. And without this financing, I'm assuming you wouldn't have been here, because I've never met a student that's borrowed student loans because they find the financial aid process to be fun. So you borrowed the money because it was the only way you could afford to make this investment. But it's very important to be thinking about how should you approach the repayment of this investment. Because one thing that's unique about federal student loans is that although I consider it to be a mortgage, it's a mortgage that is much more flexible than the conventional mortgage. And the fact that you've had to borrow money to go to law school should not be the reason you couldn't qualify to get a mortgage a lot sooner than you might have thought. But again, it involves being strategic. And I think one of the things that's important to make sure students understand is to understand how federal student loans are not like other forms of credit. And to sort of highlight that, I like to begin with three specific questions, because I think students oftentimes come in with an expectation or an assumption about how they should approach the repayment of their federal student loans. How many of you think that if you could afford to do so, you should be paying the interest that's accruing on your unsubsidized direct student loan and your Grad Plus loans now while you're in school? All right? How many of you think that once you enter repayment, you should try to get your federal student loans paid off as fast as you can? All right? And finally, how many think that it could be a good idea, if you could do so, to refinance your federal student loans with a private student loan if you could do so and get a lower interest rate. All right? Many of you thought that these would be things that would be in your best interest. In reality, there is a pretty good chance that if you did these three things, you would not be doing what was in your best interest financially. But to understand that, you have to understand how federal student loans are different from other forms of credit. So let's begin with the first question. I asked, should you be paying the interest if you could afford to do so now while you're still in school on the loans you're borrowing that are accruing interest, which is basically all of the money that you're borrowing. Now, the reason that that isn't a good idea financially is because of the nature of that interest. It is not compounding. It is accruing as simple interest. In other words, right now, you're not paying any interest on that interest. What you're paying interest on is the outstanding principal balance. And so if you had the means to be paying the interest right now, a better use of the money that would save you more total interest over the life of repayment would be to use that money to reduce how much you're borrowing this year. Because it's what you're borrowing right now that's accruing interest today, January the 28th, and will continue to accrue interest every day until you get the debt paid off. The interest itself is not going to start costing you something until it gets added to the principal balance, a process that's called capitalization, and that's not going to happen until November if you're graduating in May. It happens 6 months after you graduate. So right now, that interest isn't costing you anything. And so you wouldn't be saving as much long-term interest expense if you were paying it back. It would be better to use those funds to reduce how much you're borrowing. Does that make sense? Now, I do realize that when you did entrance counseling, and every month or every quarter you are getting reminders from the servicer, the company that's managing your loans, that they do think they are encouraging you to pay the interest if you could. And that's because behaviorally it could be a good idea because we want to get you in the habit of making payments. But the reality is it is not what's in your best interest financially. So what about the other two questions? The idea that you should get this debt paid off as fast as you can, and if you could refinance it with some sort of a private loan and get a lower interest rate, would that be a good idea? And I've suggested that it may not actually be a good idea, and it's because of the unique nature of federal student loans when you actually enter repayment, and some characteristics of those loans that are not typical or true with any other form of credit. With federal student loans, there are three things, it's the first three bullets in this slide, that make them different from all other forms of credit. And the first is that you should never have to miss a payment or default on a federal student loan. Because if you can't afford to make an upcoming payment due to a change in your financial circumstances, either a loss of income or an unexpected expense, then you can actually get payment relief. You can get permission to temporarily postpone repayment with a deferment or a forbearance, or you could get your monthly payment reduced to reflect the change in your circumstances. And as long as you arrange for that before you've actually missed the payment, then you won't have to miss the payment because you'll either get permission to postpone it or to reduce it. So doing so does not negatively affect your credit. Nor does it prevent you from getting payment relief at some other point in time in the future if you needed it. So it really creates a financial safety net that you don't have with other forms of debt. Because with any other form of debt, whether it be credit cards, a car loan, a mortgage for a home, or a private student loan, a loan that you might have borrowed to refinance a federal student loan. With any other form of debt, your monthly payment is always due when it's due, and there's usually no way that you can get payment relief. If you can't afford to pay it, your only option is to miss it. And if you miss it, now bad things start to happen. It starts to negatively affect your credit. You could likely start incurring late fees, and perhaps the interest rate or the cost of the loan could be increased due to a sort of a penalty clause in the promissory note, and eventually you might actually default. So you want to avoid those bad consequences. So with debt where you don't have the ability to get payment relief if you need it, it would be important to get it paid off as fast as you can because it's creating risk. It's not accommodating or allowing for the possibility that you might experience a situation where you couldn't afford to make the payment. But with federal student loans, that doesn't have to happen. And federal student loans are the only expense you're going to have moving forward, where basically if you can't afford to pay for it, you could get a pass. Now, it's not a free pass because the longer you take to pay back the loans, the more interest you will have paid. But that isn't causing you harm in the sense of damaging your credit or preventing you from being able to do other things financially. It is an added cost, but actually it may not be harmful to you in the long run, and that will relate to the second bullet. But my point is you want to recognize that the only expense you're going to have once you graduate and enter repayment that's going to accommodate how your financial circumstances are changing over time is going to be your federal student loan debt. Secondly, and this is an even bigger feature of federal student loans, is that with federal student loans, you actually are going to have a choice as to how much you have to pay per month, because there are currently 8 different payment plans. 4 of them base your monthly payment on the amount you owe, which is the way all other debt is structured. They're the oldest plans, and probably plans you might not want to consider using. But with federal student loans, you also have 4 options that base your monthly payment on your income. And there is no other form of credit, private student loans, private forms of credit, credit cards, car loans, home mortgages, where how much you have to pay per month once you enter repayment can be a function of your ability to pay it back and the income you have. But with federal student loans, that's possible. And without knowing anything about you, I can make the global statement that's highlighted in bullet number 2, that if you choose the repayment plan of the 8 that are available that would give you the lowest monthly payment on your federal student loans, then your monthly payments will always be less than 15% of whatever your household's monthly adjusted gross income is, which means you'll always have more than 85% of your household's monthly adjusted gross income for everything else. And there is no other form of credit. Quite frankly, there's no other expense you have where I could make that kind of a statement. And if you did not have loans prior to October 1st of 2007, then that percentage figure is not 15%, it would be 10%. So it would be an even smaller percentage of your income. So with federal student loans, you have flexibility that you don't have with any other kind of expense. Because with federal student loans, how much you have to pay per month is a function of what you can afford to pay. And if you think about it, what other kinds of debt and what other expenses do you have where how much you have to pay per month is a function of what you can afford to pay? And as your ability to afford things changes, the obligation you have here will adjust accordingly. Now, the third feature is something that is also important because for any kind of debt, even including federal student loans, it likely would be important that you have the debt paid off before you're ready to retire. Because if you don't have it paid off by the time you retire, it could make it more difficult for you financially to be able to manage in retirement. But with federal student loans, I can tell you that once you start paying back the debt, it's going to be gone one way or the other within 25 years. Either because you've successfully paid it all back yourself, or because you've qualified to have a portion of the debt forgiven by the government. And if they forgive the debt, that does not negatively affect your credit. You may have to pay some taxes on the amount forgiven, depending upon the reason it gets forgiven, but the debt will be gone one way or the other. And again, I can't say that about other kinds of credit, particularly credit card debt. Credit card debt really is designed to be out there forever. If you're only making the minimum payment on credit cards, then you're likely never going to be out of debt on credit cards. And so federal student loans provide a flexible and safe form of credit that doesn't exist with any other kind of credit. And because of that, you need to think about, is it in your best interest to pay it off as fast as you can? You certainly have the right to do it, which is the 4th bullet point. There are no penalties for prepayment, for paying it down more aggressively. So if you decide that's what you want to do, you certainly have the right to do it. But if you're paying more per month on your federal student loans, then you have to. Then it is costing you something. It's what in economics we call opportunity cost. Because that extra money you're paying on your student loans that you wouldn't have had to pay that month is now not available for some other purpose. And if you had another use for that money, particularly that was investment or savings related, and if that alternative use would have provided value to you that would have offset the added interest cost you incurred because you chose to take longer to pay back the loans, then you would be better off taking longer to pay back these loans because of the alternative uses you would have had for the extra money. But the only reason that makes any financial sense at all is because you don't have the risk with this kind of debt that you would have with any other kind of expense. Because with any other kind of debt, the risk comes from the fact that your financial future is uncertain. You don't know for sure what your income will be moving forward each and every month. You don't know for sure what your expenses will be. And so in order to protect yourself from that uncertainty, you want to make sure that if you have debt where your monthly payments are based upon how much you owe, which would be true of any other kind of debt, including that private student loan you might have thought of borrowing to refinance these, then you want to get that debt paid off as fast as you can so that you minimize your exposure to the possibility you might not be able to afford to make the payment, and therefore bad things would start happening. Here, that doesn't have to happen. This is the only expense you're ever going to have that is basically protecting you against the risk associated with the financial uncertainty you face in your lives. So I'm not sure you necessarily want to be in a hurry to pay it back, particularly given that it also, from a debt-to-income ratio perspective, should not be the reason you couldn't qualify to get a mortgage or borrow money for other purposes if you so chose to do so. So your educational mortgage, the federal student loans you've borrowed, are designed to ensure that you can get the education you want, but also to make sure it doesn't prevent you from being able to do the work you want and whatever it might produce in terms of income, and also doesn't prevent you from achieving the other financial goals like saving for retirement, buying a house, building up an emergency fund so that you'd have the safety net for all those other expenses for which it's not already built in the case of your federal student loans, and being able to save for your children's education if you plan to have a family. This is probably the most important thing I can tell you in this seminar. It's the most important thing I feel I can tell students who have federal student loans, because it's not what normally you'd expect from loans, and it's not something that is really emphasized enough when you go through entrance or exit counseling. And so, do you have any questions about this or comments before I move on? The question is, at any point in the repayment of your loans, does the interest compound? The interest will be technically capitalized once when your loans enter repayment, 6 months after you graduate. The interest that's been accruing while you've been in school and during those 6 months while you're in transition into repayment, it's accruing as simple interest. At the end of that 6-month span of time, it will capitalize once, which is a compounding, but it's a single compounding. It doesn't keep compounding. And then moving forward, you're either paying all the interest that's accruing in the payment plan you're on, or there could be instances with the income-driven plans that you can't afford to even be paying all the interest. At that point, the interest that's accruing moving forward, again, is accruing as simple interest. It may capitalize again, probably only one other time, but it may never actually capitalize again. All right, so let's go ahead and talk about the different repayment options so that you can understand what the options are, and then I'm going to talk about how do I think you should go about evaluating strategically which plan is going to best meet your needs. There are currently 8 payment plans available for repaying direct subsidized and unsubsidized loans, Stafford subsidized and unsubsidized loans, the Grad Plus loan, and federal consolidation loans. There are not repayment options available for the Perkins loan if you have a Perkins. Do any of you have a Perkins loan? All right. The Perkins loan is a loan that you borrowed through the school that you were attending at the time you got the loan. It is a federal loan, but it doesn't have a choice of payment plans. It's going to be paid back over a 10-year span of time in equal monthly payments. But for the loans you've been borrowing here at the law school, and the largest portion, if not the entire amount of your federal student loan debt that you have, there are 8 different plans. It looks like there's only 6, but I've grouped 2 together in each of the general categories. The first category are those plans, which are the oldest, that base your monthly payment on the amount of your debt. With federal student loans, when the loans were first created, the payment plans were structured the same way all other forms of debt is structured. They were based on the amount you owed, and they were based upon an amortization schedule. It was designed to look at how much would you have to pay per month to get all the debt paid off in either 10 years or in 25 years, using either payments that are fixed or are tiered. They increase in incremental steps or graduated steps every 2 years. And so there are 4 such options. There's the standard and the graduated plans over 10 years, and then there's the extended plans, which give you 25 years, and there's both a fixed and a graduated or tiered option. So those are the 4 plans that were first available. And with these 4 plans, your monthly payment has to at least equal the interest that's accruing every month. And with the plan, the extended, tiered, or graduated plan, that's the plan that has the lowest initial monthly payment of these 4 options, and it's equal to the interest-only amount. The others start out paying interest plus some portion of principal. If you don't choose a plan, then by default, you're put on the standard 10-year plan because it's the one that would result in the least amount of interest accruing over the life of repayment. And so any repayment estimates you've received in disclosure statements or from your loan servicer likely have been based upon the 10-year standard repayment plan, because until you choose a different plan, that's the plan the loans will be on. Now, as I said, these plans are the oldest plans, and the newest plans look at a different factor when determining your monthly payment. They base your monthly payment on your income. And in this case, with these plans, your monthly payment is adjusted once every 12 months based upon how your household adjusted gross income, which is always going to be your gross income, and if you're legally married and you and your spouse file a joint federal tax return, it will include your spouse's income. But if you're legally married but file your federal tax return separately from your spouse, then it does not include your spouse's income. And if you're not married, it never includes the income of anyone else. And it is not taking into consideration any of your assets. It also looks at household size, because the bigger your household, the more money you need for basic living expenses. And household size, in this case, is not based upon how you file your taxes. It always includes you. It would always include your spouse, if married, even if you file your taxes separately. It would always include your dependent children, even if they don't live with you. And it would also include anyone else who does live with you full-time and for whom you're providing more than 50% of their support, such as a sibling, a parent, a domestic partner, a boyfriend, a girlfriend. It doesn't matter what their relationship to you is. As long as they live with you full-time and you're providing at least $1 more of support than they are, then you can consider them a member of your household. The poverty guideline and your state of residence are also factored in, and I'll explain how that works in just a minute. And with pay-as-you-earn, which is the newest of the income-driven plans, as well as the new IBR plan, your monthly payment would be based upon 10% of your household's annual discretionary income, and that amount would be divided by 12 months. And once we do all the math associated with the pay-as-you-earn plan and the new IBR plan, your monthly payments would always end up being less than 10% of your household's monthly adjusted gross income. Now, in order to qualify for pay-as-you-earn and the new IBR plan, you have to be what's called a new borrower. And I'll define what that means in just a minute. But some of you likely are not new borrowers. If that's the case, then the next best option in terms of the income-driven options would be the original income-based repayment plan, and it's calculated in exactly the same way, except the percent of your income you are expected to contribute is 15% rather than 10%. And because I know all of you are potentially eligible for that plan, I was able to make that global statement on the prior slide that if you chose the repayment plan that would give you the lowest monthly payment, then your monthly payments would always be less than 15% of your household's monthly adjusted gross income. Because if the IBR plan doesn't give you the lowest monthly payment, it's going to be because one of these four plans where your monthly payment's based upon your debt is actually giving you a lower monthly payment. Now, although those plans aren't based upon your income, they are consuming an even smaller percentage of your monthly income. Is that clear? Now, with these plans, as well as the oldest plan, which I really am not going to go into because it's basically obsolete now because it would have required an even higher percentage contribution. But with these plans, it's possible, given your income and the amount of your debt, that your monthly payment wouldn't be enough to cover all the interest that's accruing. And that is actually permitted. But if that's happening, then when you're in repayment, although you're making monthly payments, your debt could potentially be getting larger, not smaller. And so it's possible that it might not be the case that you'd ever get the debt paid back. And so an added feature of these plans is that if you don't have the debt paid off in a finite number of years, then the remaining balance gets canceled by the government. It's written off. The fact that it's canceled does not negatively affect your credit, but under the current federal tax code, it is considered a discharge of debt, and so you would have to pay taxes on the amount that was canceled or forgiven. Now, there's a very good chance that Congress will make some changes to the forgiveness feature, and one of the changes that they're looking at is not making whatever amount is forgiven non-taxable. But it's also likely that they're going to make some other changes in the forgiveness features that might limit or eliminate the ability of some borrowers to get the benefit, particularly if they have higher incomes. So you never want to view the possibility that you could get debt forgiven as an incentive for paying less. View it more as a financial safety net, because there's nothing that guarantees that you'd actually get that forgiveness. The reason you may not want to pay off this debt as fast as you can is because from an opportunity cost standpoint, something you do have control over, you may have alternative uses for your extra funds that would have been more value to you. Now, you'll see I've made mention several times to the new IBR plan. For that plan, you have to be a new borrower as of July 1st of 2014. In other words, you didn't borrow any loans prior to July of last year. Well, I'm assuming you did, so you're not eligible for that plan. But the terms of that plan are exactly the same as pay-as-you-earn. And in pay-as-you-earn, you have to be a new borrower as of October 1st of 2007, which it's very likely you are. And to be a new borrower, in this case, it means that you either did not have any Stafford, Grad Plus, or Consolidation loans through the bank-based program, the FFEL program, which stands for Federal Family Education Loan Program, or through the direct program prior to October 1st of 2007. Now, if you went right from undergrad into law school, you probably started as an undergraduate in 2008, or you very likely could have. So you may not have any loans prior to October 1st of 2007. So then you would meet the new borrower definition. If you did have loans prior to October 1st of 2007, then you could still be considered a new borrower if they were fully repaid before you took out your first new federal loan on or after October 1st of 2007. Now, if you're not sure whether or not you're a new borrower, then all you have to do is to contact the loan servicer, the company that's managing your loans for your lender. And for your direct loans, it's either Fed Loan Servicing, Great Lakes, Nelnet, or Navient. If you call them and ask them, am I a new borrower for purposes of pay-as-you-earn, they should be able to look at your loan history to determine whether or not you meet the requirements. The other requirement that's listed here is one that you all satisfy, so it's not an issue. This is just an explanation of the new borrower requirement for the new IBR plan, which likely none of you satisfy. But as I said, this plan is exactly the same as pay-as-you-earn. Now, how do we come up with this amount of discretionary income? Because clearly that's an important amount, because the amount you're paying each year is based upon what the government considers to be your discretionary income. But it is very important to understand that what they consider to be discretionary is not likely the same amount you're going to consider to be discretionary. They have a very specific definition. And the amount of discretionary income is equal to your household's adjusted gross income. And once again, that's always going to be your gross earnings. And technically, it's the bottom number on the front page of your federal tax return. And then if you're legally married and you file a joint federal tax return with your spouse, it will include your spouse's income. In any other situation, it's only going to be your income. So it's going to look at your household's adjusted gross income. But we know that you need some of that income for your basic living expenses. And so a portion of your gross income is protected. And the amount that's protected is equal to 150% of the federal poverty guideline, that other factor I mentioned in that previous slide. And that amount is an amount that currently is equal to $17,505 for a household size of 1. Well, that's about $1,400 a month. So they're not protecting a lot of income, and it's very likely that your actual living expenses would exceed that amount. But at least they're protecting some of it, and the more people you have in the household, the bigger the amount that gets protected, because the bigger the poverty guideline, for the bigger the household, because you literally have more mouths to feed. But the rest of your adjusted gross income is what the government considers to be discretionary. And of that portion, with pay-as-you-earn and the new IBR plan, you'd be expected to contribute annually 10% of that amount. And so the monthly amount would be 1/12 of it. And as I said, once we do all the math associated with that, it is always going to be the case that with these two plans, your monthly payment would always be less than 10% of whatever your household's monthly adjusted gross income ended up being. With pay-as-you-earn, it's exactly the same process, it's just a higher percentage factor. Now, one other requirement for you to be able to enter these plans is that at the time you want to enter the plan, based upon your income, IBR or pay-as-you-earn, it has to be the case that you're experiencing what's called a partial financial hardship. Now, don't stick with those words, because the words imply something fairly negative. But what is true when you have a partial financial hardship is that when we calculate what your monthly payment would be based upon your income, if that monthly payment amount ends up being less than what you would have had to pay under the standard 10-year plan, the default plan, then you have a partial financial hardship, and you're eligible to enter this plan. And once you're in the plan, you'll never get kicked out. If your monthly payment based upon your income when you want to enter the plan would actually end up being more than the standard 10-year amount, then you're not going to be eligible for the plan. But I don't know why you would have wanted to choose it, because it would have required a higher monthly payment. And I don't think strategically you want to choose a plan that requires you to pay more. It would be better to choose a plan that requires you to pay less, and then if you want to pay more, do so voluntarily, because then you have more control over that amount. So it's possible that for some of you, depending upon how much you've had to borrow to complete your education and what your income is, you may not actually have a partial financial hardship. And so you may not, at least initially, be eligible to choose these options. But that's only going to mean then the standard plan would have given you an even smaller monthly payment, and the extended plans would be smaller yet. Does that make sense? All right. So this is a chart for 2014 because the poverty guideline was just changed, so I haven't had a chance to update the chart. It went up a little bit. So these amounts are all going to be a little bit less for 2015. But I've highlighted for an income of $60,000 what the initial monthly payment would be for a household size of 1 under pay-as-you-earn in the new IBR plan and under the original IBR plan, the 15% option. Now, what you want to notice about this chart is several things. One of them is you'll notice something is missing. Nowhere on this chart is there any reference to the amount you owe. And that's because it doesn't have any bearing on these amounts. The only impact the amount you owe has on these options is whether or not you have that partial financial hardship. As long as you have the partial financial hardship, that's the only way in which your debt impacts the plan. It does not in any way impact the monthly payment. The other thing to note is that I've sort of maxed out the chart at $100,000 of income and a household size of 3. That is not to suggest that if you had more than $100,000 of income, you wouldn't be eligible for the plan. There are no income caps or thresholds, at least currently, on these options. It's just that if I included more incomes, the print would have been a lot smaller, and I didn't think that would be beneficial to you. There are no household size or income restrictions that would cause you not to be eligible to enter these plans. And once you're in the plan, you're never kicked out. If you do reach a point where your monthly payment based upon your income would exceed what you would have had to pay originally under that 10-year plan, then it maxes out or caps out at that 10-year amount. You're still in the income-driven option. You don't have to exit the plan, but your payments stop increasing. They cap out at whatever that amount was. Any questions about these options? Now, to get on these plans, you have to apply for them because the servicer has to know what your income and household size are, and they collect that information through an application. That application is available on the website where you actually applied for your direct loans. It's at studentloans.gov. Once you submit the application electronically, you will have to resubmit it every 12 months because every 12 months you are required to update the servicer with your income and household size information. And they will prompt you about 60 to 90 days in advance that it's time to do that. But it also highlights the fact that you're only required to update your income once every 12 months. So once you've got your monthly payment set, it's set for 12 months. Now what happens if during those 12 months your income increases? Are you required to notify the servicer of that? The answer is no, not under the current rules, because you're only required to update that information once every 12 months. So you would continue making that same required monthly payment for the duration of that 12-month payment cycle, even though at that point your income increased. Then when it's time to reapply, they'll take your new income into account to establish what your monthly payment will be for the next 12 months. But they're not going to go back and change anything about the past. But what if the opposite happened? What if during the 12 months you had a loss of income? Are you required to notify the servicer? No, but you would want to because now you need payment relief. Now you likely can't afford that monthly payment, and they will adjust your monthly payment downward to reflect the change in your circumstances. If you notified them that you had an income increased during the 12 months, they would not adjust your monthly payment upward. You could voluntarily pay extra if you want, but they would not change your regular monthly payment. All right. Questions about that? Oh, I need to change the option here, I see. Sorry. Any questions about the application? All right. Question. When do you apply? The first date you can apply is 30 days before the loan enters repayment, because the servicer does want the most accurate information about your income on the date you apply for the coming 12 months. So the earliest you can fill out the application is 30 days before the loan would enter or re-enter repayment. And I mentioned that worksheet that you can get from the law school's website. That's all explained under step 3 of the worksheet, and it gives you the reference to the website where you would apply. Other questions? Okay, the question about consolidation, can we wait just a minute? Because I'm going to cover that in a few minutes. All right, any other questions about the repayment options? All right, I think an easy way to understand them is to actually go ahead and see what your monthly payments would be. And there's actually a repayment estimator or a calculator available now out at studentloans.gov. And to get to that repayment estimator, all you have to do is sign in on studentloans.gov. And you can sign in with the first 2 letters of your last name, your birth date, and the PIN that you used when you filled out the FAFSA. If you don't remember the PIN, you can get a duplicate PIN at the PIN website. Once you log in, this is the welcome screen. You'd want to go to the repayment estimator. Let me also point out that there's other things you could do at this website, and we'll show you what those are in a minute. Once you click the repayment estimator, then it's going to show you this screen. Now, this is actually my information, not yours. And I did have student loans when I was getting my PhD in economics, but they're all paid back. So the balance on my loans is 0. If when you go to this website, your balance is 0, then I'm not sure why you're sitting here, because it means you don't have any federal loans. Now, if you have private student loans, they're not showing up here, because they're not eligible for these repayment options. With your private loans, the payment's based upon, getting it paid off in your 10, 15, or 20 years, some sort of an amortization schedule. So what you'll see is the amount you owe, and that will be the sum of the outstanding principal and the accrued interest. It's going to be the combination of the two. Even though right now they're tracking separately, it's going to add them for purposes of calculating the monthly payments. The interest rate you'll see there will be the weighted average of the interest rates of your loans. And unless you borrowed Stafford loans prior to July 1st of 2006, all of your federal loans have fixed interest rates, but they likely have different rates for different times and different types of loans. If you click, seeing the blue arrow, if you click where it says view or add your loans, you can actually see a listing of all your federal loans. They'll be grouped according to which company is currently servicing that loan. So for your direct loans, they'll be grouped together, but they'll be listed in chronological order, and it'll indicate who the servicer is, which will either be Fed Loan Servicing, Great Lakes, Nelnet, or Navient. It'll give you the servicer's phone number. It'll show you the amount you owe, the sum of the principal and the accrued interest. It'll show you the interest rate, and then it's going to have a chart showing you the different repayment options, and it's either going to have a green check mark or a red circle with a slash. If it has a red circle with a slash, then that means that loan is not eligible for that repayment plan. So for example, if you're not a new borrower, therefore not eligible for pay-as-you-earn, it would have a red circle. It actually won't have a red circle there. If it's not a direct loan, it'll have a red circle because only direct loans are eligible for pay-as-you-earn. If you have Perkins loans, they're not eligible for any of these plans, so they'll all have red circles with slashes. If it has a green check mark, though, it does not mean that loan is automatically eligible for that plan. It may be, but it'll be dependent upon 2 things. Do you have a partial financial hardship, and are you a new borrower in terms of some of the income-driven options? So just because it has a green check mark doesn't guarantee that you'll be eligible. Now, you'll also see that there will be probably 4 graphs there for the 4 plans that base your monthly payment on the amount of your debt. Because since we know the amount of your debt, the estimator can actually calculate what your monthly payments would be. They don't need any additional information. But for the 4 plans based upon your income, you have to provide that information. And that's what you provide in Section 2 and Section 3. In Section 2, the black arrow is where you'd indicate your tax filing status. Because if you're married filing jointly, then you also have to provide your spouse's income information, but you also have to provide your spouse's student loan debt information. Because if we're going to take into account your spouse's income, we also have to take into account the fact that your spouse has debt, if they do. If you're married filing separately, single, or head of household, then it's not going to ask for your spouse's debt. Then you'll enter the income figure, either your income, or if married filing jointly, your combined incomes in the AGI box, household size, whatever it is, and then your state of residence. The state of residence matters only if you're living in Alaska or Hawaii. The poverty guideline is different for those 2 states than from the rest of the 48 states. It's a little bit higher in those 2 states. Once you enter that information, then it will display the graphs for those additional income-driven options for which you're eligible because you have a partial financial hardship. So it will look like this. And here I assumed a total student loan debt, and this is just the amount owed. I did not factor in any interest that accrued, of $77,000. So the amount you actually would likely owe, if I had factored in the interest, would have been more. The weighted average interest rate I calculated or assumed to be 6.34% based upon how this individual might have borrowed loans here at the law school over the last 3 years. Combination of Stafford, unsubsidized, and Grad Plus loans. I assumed a starting salary of $61,000, household size of 1, living in Kentucky. You see that there are 8 graphs, so it shows that for these 4, this borrower, because there is a graph for the income-based repayment plan, the new IBR plan, pay as you earn, that the borrower did have a partial financial hardship because you see the monthly payment based upon their income was less than the amount under the standard plan. If the calculations here would have caused the payment to be larger than that, then you wouldn't have seen a graph because it wouldn't have calculated, it wouldn't shown a monthly payment amount. All right? So we see here that the lowest monthly payment would be the pay-as-you-earn plan. The next lowest option would be the purple, which is the extended graduated plan over 25 years. Now, if you scroll down, then it'll show you this information in a chart. For each of the plans, it's showing you the length of the repayment period, and for the first 4 options, that's fixed. It's either 120 months, which is 10 years, or 300 months, which is 25 years. For the other 4, it can be up to 240 months or 300 months, depending upon whether or not the debt gets paid off before it would get canceled. In this case, we see that in all 4 scenarios, based upon the assumption that the borrower's income is increasing at an annual rate of 5% and their household size wasn't changing, that they would in fact have all the debt paid off before they reach that 20-year limit on the pay-as-you-earn and the new IBR plan, and before the 25-year limit on the original IBR and income contingent repayment plan. So there wouldn't be any debt left to forgive. If they had had more debt or less income, then it's possible that they might have had debt left to forgive, and that would have been shown here. It would have just been an estimate, though, based upon those assumptions. And how your actual monthly payment will be changing under the income-driven options will be based upon how your income and household size actually are changing every 12 months. Any questions about this? Because you can go and do this all for yourself. Now, once you do it, though, one thing I want to go back and point out is that notice that I have some additional information here. You could add in additional loans. For example, if you're not a third-year student, or if you're going to have to borrow some more money before you graduate, you could add in that additional amount just to sort of see how that would change the picture. Here is where the consolidation application is. We're going to talk about that in a minute. Here is where the application for the income-driven plans is. And here, this yellow arrow points to a little yellow envelope. If you click on that yellow envelope when you're on this site, it'll allow you to email the results to yourself in an Excel file. So I'd encourage you to do that. You could also print out the results. You could go to Twitter and tweet that you've done this, or you could share it on Facebook. I don't know why you'd use social media for that purpose. All right, any questions about the repayment options? All right, the final, or not the final, but probably the next most important thing to talk about is, so how do you decide which plan to choose? Well, faster may not be better. Remember, I said, it may not be in your best interest financially, given the unique, flexible, and safe attributes of federal student loans, to pay off this debt as fast as you can. You certainly have the right to do it if you want to, but it may not be in your best interest because you may have better uses for your extra money from an opportunity cost perspective. An opportunity cost is simply looking at trade-offs and evaluating what is the highest and best use of your scarce resources, in particular your money. Because if you're using your money in a way that is not allowing you to get the greatest benefit from that money, then you're giving up benefits. And if those foregone benefits would have had more value to you than the way in which you use the money, then you're actually worse off. So if, for example, you could be investing that extra money and giving an average annual rate of return through your retirement investments or other types of investments that was more than the interest rate you were paying on your loans, then you will be losing money by paying off your loans more quickly. You're going to be losing interest earned in terms of the investments you could have made. That's just one example. So you want to remember that once you start earning income, you really have to decide how to allocate that income across 4 buckets. The past, the present, the future, and philanthropy. The past is the minimum amount you have to be paying each month on all of your debts. It's just that with federal student loans, you have the unique opportunity to decide how much you have to pay per month. You'll have a choice. And if you could actually afford to pay more than the minimum plan would have required, then you have to decide, are you going to use that extra money for your federal student loans, or are you going to use it for some other debt, which would be a better use because that other debt doesn't have those safe, flexible features? Or if federal student loans are the only debt you have, are you going to consider putting it in one of the other buckets? Well, the other bucket I encourage you to look at is the future bucket. Because financial planners, and I'm not a financial planner, I'm an economist, but they would suggest that you should always pay yourself first once you're earning income before you pay anybody else. And ideally, you want to be paying yourself first a minimum of 20% of your gross monthly income. So for that $61,000 of income I was talking about, that would be a total of $12,200 a year, or just about a little over $1,000 a month that you should be investing or saving for the future. And at a minimum, you want to be aware of some of those future needs. The rainy day fund. What about all those expenses you have for which you don't have the built-in safety net? That built-in ability to get adjustment or payment relief if you need it on your federal student loans. So for all your other debt, all your other living expenses, if you don't have 6 to 9 months of your expenses set aside in savings, then you're not in a financially secure position. You couldn't weather a financial downturn. And yet that would have value to you to be able to do so. Now, it's not easy to quantify it, but it certainly, I would think, would be important to you. So you want to weigh that against not doing so you can get your federal student loans paid off more quickly, because the cost of you doing that is exposing yourself to risk, a higher level of risk. Investing for retirement. You should be investing a minimum of 10% of your gross monthly income starting at the age of 21 if you hope to have the same lifestyle in retirement at age 65 that you had when you were working. Now, I know you'd say to me, Jeff, that's exactly what I've been doing because I've been earning nothing and 10% of nothing is nothing, so I must be right on track. Well, no, you're actually already behind. I don't say that to scare you, but if you don't start contributing to a retirement fund, a tax-deferred retirement plan, once you do start working, you're going to fall farther behind. And if your employer is willing to match a portion of what you're contributing to a tax-deferred retirement plan, if you're not at least contributing the minimum amount necessary to maximize their match, then you're throwing away free money. Now, you're going to be investing in a 401k, a 403b, an IRA, something that's a tax-deferred retirement amount. So you're also getting the added benefit. You're not only building up an asset that is hopefully compounding every day, and hopefully it gives you an average annual rate of return that's more than what you're paying on your loans, because if we look at the stock market over the last 25 years, it has averaged an annual rate of return that's more than the weighted average of the interest rate on your federal loans. But you're also getting the tax benefits, because if you're contributing money before you pay taxes on it to a retirement plan, then it's lowering your gross taxable income, so it's reducing the amount you're paying in taxes and increasing your monthly take-home pay. If you plan to have kids, when are you going to start saving for their education? And when are you going to start saving the cash you're going to need to buy the house? You're going to have a minimum of 10 to 20% of the cost of the house in terms of a down payment and closing costs. And the sooner you can buy the house, the sooner you're going to get the benefits of having that mortgage and having the ability to start building up equity in your own asset, an asset that's hopefully also appreciating in value, and the tax benefits. So you just want to make sure that you're thinking about that. So the bottom line is, I think strategically, all of you should consider choosing the payment plan that gives you the lowest required monthly payment, because that's going to give you the most financial flexibility. I don't know what payment that plan is going to be for you, but it's going to be one of the 8. Whichever one gives you the lowest monthly payment is going to give you the most flexibility in deciding how you could spend any extra money you feel that you have. And the extra money you could either choose to pay on your federal loans, but you could then prepay and target the prepayment at the loan with the highest interest rate, would save you more total interest, or you could use it for some other purpose. But at least it's giving you the flexibility to do that. And in order to be successful, you want to make sure you have an action plan so that you know what you have to do when you need to do it. Before I move into this very quickly, any other questions? What was your question about consolidation, by the way? Oh, okay. Sorry about that. I'm going to cover it quickly, but I know some of you may have to leave for class in 5 minutes. Question? The question is, do you have to consolidate your non-direct loans, such as the FFDL loan or the Perkins loans, to make them eligible for payment plans that are only available for the direct program, which is true of the pay-as-you-earn? And yes, that would be a reason you'd want to consolidate or refinance your federal loans in the federal consolidation program, so that you could take those non-direct federal loans and make them eligible for the pay-as-you-earn repayment plan. Yes. It would also then make them eligible for the Public Service Loan Forgiveness Program. And that's, quite frankly, the primary reason students should consolidate federal loans now, is because they have non-direct federal loans, but they're wanting to take advantage of benefits with federal loans that are restricted or only available to direct loans. You want to make sure you know what, another question.
On the plan, if you want to go for like an extended plan, like an extended class, do you have to have any type of like showing, like hardship showing? Is that like an extender that's in you if you want to go, I think like close to extended
25
years?
The question is, and I'm going to paraphrase, do you have to do anything to demonstrate eligibility for the extended repayment plans? The only requirement to be eligible for the extended repayment plans is that you have more than $30,000 of debt in that type of loan. In other words, you have more than $30,000 of direct loans, or you have more than $30,000 of FEL loans, because if you don't, then your monthly payment would likely not even cover all the interest that's accruing. So you'd have an issue of negative amortization. But you don't have to show financial hardship or anything like that. They are options that are available to you as long as you have enough debt that it would warrant using them. All right. You need to know certain things about your loans. You want to know what type of loans, particularly if you have non-direct federal loans. You want to know the interest rate and when the interest is going to be capitalized. You want to know how much you owe. Who do you have to repay? The servicer, and how to contact them. When does repayment begin? It's going to be 6 months after you graduate for your direct unsubsidized loans and your Grad Plus. But if you have Perkins loans, it would be 9 months. And if you have loans you borrowed prior to coming to the law school that you'd already used up the grace period, then they're going to go into repayment as soon as you graduate. So you want to be aware of what loans you have and will they be entering repayment at different points in time. And you want to know the repayment options and so forth. The best place to gather all of that information except the repayment options is NSLDS, the National Student Loan Data System. And you can access your records here using the same information you use to access studentloans.gov. And so I'd encourage you to do that. You're going to have to repay the servicer, the company that's managing the loans for your lenders. And for your direct loans, these are the 4 servicers that your loans initially would have been assigned to. And your loans will all be with just one of these companies. They won't be spread out across multiple companies. The government currently uses 11 different companies to service its loans. Your loans will always be kept together with a single servicer, but over time, the government may move your loans from one servicer to another, but they'll always keep them together. So you'll always have a single point of contact, and as a result, you'll also always get a single monthly bill and only have a single monthly payment for those loans that are owned by the government and the Department of Education. If you have Perkins loans, that's going to be a separate servicer because it has a different lender. It's the school you're attending. If you have non-direct or FFEL, Stafford, Grad Plus, or Consolidation loans, they may now be owned by the government, or they may still be with a bank-based lender, and in which case they will be with a different servicer, and that would represent a different or separate monthly payment. You want to create a spreadsheet, but the best way to create this spreadsheet with all this information is to simply click that little yellow envelope at studentloans.gov, because it's going to provide you with a spreadsheet that has all of the loan information that you need. Repayment begins, in the case of loans with a grace period, after the grace period ends, which for your subsidized and unsubsidized direct or Stafford loans, it'll be 6 months after graduate. You don't have any subsidized direct loans from law school, but you do have unsubsidized direct Stafford loans. You may have had unsubsidized loans prior to law school, and if you went straight from undergrad into law school, then although you started using the grace period, you didn't use it all up, so you still have it. Perkins loans have a 9-month grace period. Private and institutionally funded loans typically do have a grace period, but you'd have to contact the lender. The Grad Plus loan does not have a grace period. It's actually already in repayment, but while you're in school, it's deferred with an in-school deferment automatically. Once you graduate, it's going to get another deferment for 6 months automatically, a post-enrollment deferment, and you won't have to request it, but you'll get some information or you get some communications that one deferment has ended and you're getting a new one. But they're all going to enter repayment 6 months after graduate in terms of the loans you've gotten here at law school. If you previously took out a consolidation loan, it's going to go in repayment as soon as you graduate. It was in repayment when you started law school. It's been in an in-school deferment while you've been in law school, but now it's going to go back into repayment when you graduate. But remember, if you can't afford to start making payments on loans that are going to go in repayment as soon as you graduate, all you have to do is contact your loan servicer, explain why you can't afford to start making payments, and they'll either help you to get postponed repayment with a deferment or forbearance, or they may suggest, if you have no income and you would have wanted to choose one of the income-driven plans, go ahead and get on the plan. Because if you have no income, your monthly payment would be zero. And a monthly payment of zero in the income-driven plans is a month that counts towards towards earning the forgiveness. So that would be a better option. But in either case, once a loan enters repayment, you either have to take action to start making payments or resume making payments. And if you haven't been making payments on the loan before, you'll have to choose the payment plan you want. Otherwise, you'll be put on the standard plan. Or if you can't afford to start making payments, you need to contact the servicer to arrange to postpone repayment with a deferment or forbearance. You can't just let it happen. You'll have to request it. You'll have to take action. So you want to make sure that in that spreadsheet you've indicated when the loans will enter repayment. And that will not be originally in that spreadsheet you get from studentloans.gov, because on that website it doesn't have information about repayment. But if you then take and add a column to that spreadsheet, you can add that information in. Any questions about the timing? We've talked about picking your plan. Just remember that for your direct loans, all of your loans that are owned by the Department of Education, you are going to get a single itemized monthly bill, which you can pay by check, you can pay online, or you can actually sign up to have the payments automatically deducted from your checking or savings account. If you sign up for the auto pay option, then the government will reduce your interest rate by 0.25%. And right now, that's the only way you can lower the interest expense on federal student loans. Other lenders, other servicers, if you have federal loans with other lenders or other servicers, may offer an auto pay option, but don't assume that they're going to offer you any kind of an incentive or benefit from signing up for it. If you decide you want to start prepaying on your federal student loans, you have the right to do it without penalty, and whenever you voluntarily pay extra, you get to decide which loan you're paying down. So you'd want to pay down the loan that had the highest interest rate. You'd save more total interest. With your scheduled payment, it really represents the sum of the minimum payments you owe on each of your loans that month. So it's going to be applied proportionally to the outstanding balances. You don't get to target it in any way. But if you pay extra, then you can specify that you want it to go to that higher interest rate Grad Plus loan if you want. That's why I said I think it's in your best interest, regardless of what you plan to do, to choose the option that would give you the lowest monthly payment. Because then you can either use the extra money for some other purpose, like the future bucket, or you could use that extra money to maximize the amount you can afford to pay in a targeted way through prepayment at your federal loan that had the highest interest rate. Does that make sense? If you decide to make a prepayment, though, make sure you call the servicer the first time you intend to do so, to find out what procedurally you need to do to make sure that they treat it in exactly the way you intend. All right, consolidation is not the combining of things, it's refinancing. You're borrowing a new loan called the Federal Direct Consolidation Loan to pay off one or more of your existing federal student loans. But only federal student loans are eligible. So if you have private student loans or you have institutionally funded loans, they're not currently eligible. But consolidation doesn't get you a better deal. It actually is going to slightly increase the interest expense, and that's because of how the interest rate is calculated. It's fixed, and it's equal to the weighted average of the interest rates of the loans you're consolidating. And due to the mathematics of weighted average, although that would result likely in a different interest rate, it will not have changed the interest expense on the total amount of that debt. But then it gets rounded up to the nearest eighth of a percent. And because of that rounding up, it is going to slightly increase the interest expense. So if you don't need to refinance loans, I don't think you should, because why pay even a penny more of interest than you have to if you're not going to get some other benefit to do it? But if you have non-direct federal loans, then there could potentially be a benefit from refinancing those loans so that the new loan, which would be a direct loan, is now eligible for those benefits for which those loans weren't previously eligible. To apply for the consolidation loan, as I showed you, you'd simply go out to studentloans.gov in the left-hand margin down near the bottom, and the loans have to at least be in their grace period or in repayment, deferment, or forbearance before you can apply to refinance them. The reasons to consolidate are primarily going to be because you have non-direct federal loans. The only reason that I think you'd want to consolidate a direct loan is either because you have a direct loan, Stafford loan, that you borrowed in some prior degree program prior to July 1st of 2006 that has a variable interest rate. Since the new loan would have a fixed rate, you could lock in the interest rate on that loan while it was low, and right now it is very low. You likely don't have any loans with variable rates, because if you didn't have loans prior to July 1st of 2006, you don't have any. The only other reason I think you'd want to consolidate a direct loan is if you have a direct Grad Plus loan and you needed an endorser to qualify for the loan. At the time you applied for the loan, if you had adverse credit, if you had some credit issues, and therefore the government wasn't willing to let you take out the loan yourself, you would have had to apply with an endorser. And if you want to get that redemption or release from the obligation, you have to pay off the debt. Well, one way to pay it off is to consolidate. And that would be the fastest way to accomplish that, because the consolidation loan does not have any credit criteria, so you wouldn't need an endorser for the consolidation loan. Any questions about the reasons why you might want to consolidate? All right. Public service loan forgiveness is a benefit where you could potentially have the remaining balance on your federal direct loans forgiven after 120 months of qualifying public service. And a month of qualifying public service is a month where you've been a paid employee of either a government agency or a nonprofit organization, a qualifying public service organization, and you made a scheduled on-time qualifying payment using one of the income-driven repayment options. If you meet those requirements after 120 months of doing so, and the months don't have to be consecutive, you could take time off, you could work in the private sector, then you just start up where you left off once you resume public service. You could apply to have the remaining balance forgiven, and in this case, the forgiveness would be tax-free under the current tax code. If you want more information about this program, you can come to the seminar tomorrow or watch the video of it. Remember, be strategic. You have the ability to make choices. Make sure you're making the choices that are going to be in your best interest. And remember, your financial future is a future faced with risk. The risk of uncertainty about your income and uncertainty about your future expenses. And the only expense you are likely going to have moving forward that takes that risk into account are your federal student loans. So make sure you're thinking about how you can take advantage of that safety to help you not only succeed in repaying your federal student loans, but also succeed in achieving other financial goals that might be important to you, and the sooner you can accomplish them, the better off you will be. For more information, the best source is always going to be your loan servicer, the company that's actually managing your loans for your lending. If you want to look online, the best source is going to be studentaid.gov, but if you want information specifically about federal loans, it would be studentloans.gov. If you want more information about the Public Service Loan Forgiveness Program, then go to studentaid.ed.gov/public service or call Fed Loan Servicing, the contractor that is managing this particular benefit for the Department of Education. And if you're not sure whether you have private student loans or not, you can always check your credit report to see if they're listed there, because they should be, and you have the right, as a result of the FACT Act of 2003, to get a free copy of your credit report every 12 months through annualcreditreport.com. So I'd encourage you to do that, not only because you want to verify you don't have any private loans, but also because it's just a good financial habit to get into, because you want to make sure all the information on your credit report is correct, and that you have not become a victim of identity theft. With that, good luck to all of you. You know, you've made an important investment in your lives. The fact that you've had to borrow money to do so should not be the reason you can't accomplish your career and your financial goals in a reasonable amount of time. But in order to do so, you've got to take charge of loan repayment. You've got to be strategic in thinking about what choices, in terms of the options you're going to have in repayment, will best meet your needs. Recognizing that once you've picked a payment plan, you have the right to change your mind and to switch plans if you need to. You have the right at any point in time to pay extra. But once you've paid money to the lender, you're not going to get it back. And once you've refinanced loans through consolidation, you cannot undo that. So you just want to make sure that when you're making decisions, that you're making the decisions that will be in your long-term best interest. And with that, thank you for your time. I will stick around and answer individual questions. And if you didn't have a chance to sign up for a one-on-one meeting with me, but you'd like to, check with Alice Foley in the admissions office, because there may still be a couple of appointments available to you either later today or tomorrow. Good luck, and make sure you check out the handout and that worksheet on the law school's website. Good luck to all of you.